Warren Buffett's first rule of investing is a lie. You've heard it a million times, right? Rule number 1, never lose money. Rule number 2, never forget rule number 1. It's the most famous piece of advice in finance, repeated by everyone from Wall Street gurus to your uncle at Thanksgiving. But what if blindly following that advice is actually a dangerous trap? Here's a little secret. Buffett himself has lost money. A lot of it. He admitted his timing was terrible when he bought ConocoPhillips right before oil prices tanked. He lost quite a bit of money on Paramount. And his purchase of Dexter Shoe Company was, in his own words, his worst deal ever. That one was a double whammy because he paid with Berkshire Hathaway stock, a mistake that ultimately cost his shareholders what would be billions today. The truth is, he's playing a completely different game, and that don't lose money mantra is just the public-facing part. Today, we're pulling back the curtain on the real meaning behind this famous quote, a secret that completely changes how you find winning investments and separates the legends from the average Joes. So, if the world's greatest investor loses money, what gives? Is his most famous rule just a clever soundbite? Not quite. And this is where most people get it completely wrong. The rule isn't about never ever seeing a stock price dip. It's not about dodging a little market turbulence. It's about one incredibly powerful idea, avoiding the permanent loss of capital. That's the real secret. That's the entire game. And understanding this one distinction is what separates disciplined, long-term investors from people who are just gambling in the stock market. Let's get real. When the market has a panic attack and drops 20%, your portfolio is going to take a hit. It's a paper loss. It feels awful, sure, but it's not permanent. Berkshire Hathaway's own stock has been cut in half on 3 separate occasions. Buffett didn't sell in a panic because he understands the crucial difference between a company's price and its actual value. A permanent loss of capital is a different beast entirely. It's when you buy into a business and that business fundamentally breaks. It goes bankrupt, its big advantage over the competition disappears, or its ability to make money is just gone for good. When that happens, your money is gone, forever. If you lose 50% of your capital, you need a 100% gain just to get back to even. That's a mathematical black hole that is almost impossible to escape. Buffett's first rule isn't about protecting you from a bad month. It's about protecting you from making a catastrophic mistake that takes you out of the game for good. So how does Buffett put this deeper rule into practice? It all comes down to a simple but profound idea he learned from his mentor, Benjamin Graham, the margin of safety. Think of it like building a bridge. If an engineer knows the bridge needs to hold 10,000-pound trucks, they don't build it to handle 10,001 pounds. They build it to handle 30,000 pounds. That extra capacity, that cushion, is the margin of safety. It's what protects you when things don't go exactly as planned. Buffett does the exact same thing with stocks. He doesn't just look for good companies. He hunts for good companies trading at a price significantly below their real underlying worth, what he calls their intrinsic value. That discount is his margin of safety. It's his built-in protection against being wrong. He's not trying to buy a business worth $83 million for $80 million. He wants a massive margin for error. The focus is to avoid permanent capital loss. If his analysis is a little off or the company hits an unexpected rough patch, that cheap purchase price acts as a buffer. He might still have a temporary paper loss if the market sours on the stock, but he has dramatically reduced the risk that the investment goes to zero. This mindset completely changes your approach. You stop thinking like a stock trader and start thinking like a business owner. A trader asks, "What's the price going to do tomorrow?" An owner asks, "How is this business doing, and will it be stronger in 10 years?" Buffett has famously said that if you aren't willing to own a stock for 10 years, you shouldn't even think about owning it for 10 minutes. It's why he's owned Coca-Cola since 1988. That's not a trade. It's practically a marriage. He understood the business, its unshakable brand, and its reliable earnings. He bought it with a margin of safety and has held on through recessions, market crashes, and global crises, all because the underlying business itself remained rock solid. Okay, so how does knowing this lie make you a better investor right now? It forces you to change the questions you ask before you ever hit that buy button. You stop asking, will this stock go up? And you start asking, what is the real, measurable risk that I could be permanently wiped out on this investment? To answer that, you have to do the work. Here is a simple, 3-question framework inspired directly by Buffett's philosophy to build your own margin of safety. Can I explain this business to a 10-year-old? Buffett calls this the circle of competence. He famously advises, never invest in a business you cannot understand. If you can't clearly explain how a company actually makes money, what makes it special, and why it'll still be relevant in a decade, you have no business owning it. This one rule alone will save you from speculative bubbles and trendy, complex industries where you have zero edge. You're far less likely to suffer a permanent loss when you actually get what you own. Does this business have a durable competitive advantage? This is what Buffett famously calls a moat. A moat is the defensive barrier that keeps competitors away. It could be a brand with immense power, like Apple or Coca-Cola, a low-cost structure, like GEICO, or a network effect, like American Express. A company with a wide, deep moat can protect its profitability for decades. A business with no moat is vulnerable, and vulnerable businesses are where permanent capital loss lives. When a moat starts to shrink, that's a massive red flag. Is the price I'm paying low enough to protect me if I'm wrong? This is the margin of safety in action. Remember, a wonderful company can be a terrible investment if you overpay. Your goal is to buy wonderful companies at a fair price, or fair companies at a wonderful price. You need to make a conservative estimate of what the business is really worth and then demand a discount. Buffett sometimes looks for a discount of 30% or more. This isn't about buying cheap junk stocks. It's about buying good businesses for less than they are truly worth. This discipline provides that essential buffer against the only thing that really matters: a permanent, irreversible loss. Answering these 3 questions honestly takes patience and discipline, but it shifts the odds dramatically in your favor. It forces you to say no to almost everything and yes only when you have overwhelming conviction. So no, Warren Buffett's first rule isn't really a lie, but the way most people hear it is dangerously incomplete. It's not a simple command to never lose a dime. It's a deep, philosophical guide to managing risk. The rule is, don't put yourself in a position where you can be permanently wiped out. It's a rule about diligent risk assessment, not naive risk avoidance. It's about understanding that market volatility is just temporary noise, but a permanent loss is a disaster that shatters your ability to compound wealth. Once you make that mental shift, everything changes. You're no longer playing the market's game of short-term guessing. You're playing your own game of long-term ownership. You're not buying lottery tickets, you're buying pieces of real businesses. And that is the true secret to finding winning investments and building wealth that lasts. If this video changed how you think about investing, hit that subscribe button for more insights that go beyond the surface-level advice. And let me know in the comments, what's another investing rule you've always questioned?